Hello guys, welcome to How to Money. Today we'll be talking about REITs or Real Estate Investment Trust, a very simple and effective way to make passive income with the stock market. The effects of the pandemic during 2020 made it a tough year for real estate investment trust. Even with this generous dividend, the real estate sector suffered at least 2% loss last year. But what is a real estate investment trust or REIT? A real estate investment trust is a company that owns, operates, or finances income-generating real estate. Modeled after mutual funds, REITs pool the capital of numerous investors. This makes it possible for individual investors like you and me to earn dividends from real estate investments without having to buy, manage, or finance any property themselves. Properties in a REIT portfolio may include apartment complexes, data centers, healthcare facilities, hotels, infrastructures like in form of fiber cables, cell towers or energy pipelines, office building, retail centers, self-storage, timberland and warehouses. In general, REITs specialize in a specific real estate sector. However, diversified and specialty REITs may hold different types of property in their portfolios, such as REITs that consist of both office and retail properties. Many REITs are publicly traded on major security exchanges, and investors can buy and sell them like stocks through the trading session. REITs typically trade under substantial volume and are considered very liquid instruments. What qualifies as a REIT? More REITs have a straightforward business model. The REIT leases space and collects rents of the properties, then distributes that income as dividends to shareholders. Mortgage REITs don't own real estate but finance real estate instead. These REITs earn income from the interest on their investments. To qualify as a REIT, a company must comply with certain provisions in the Internal Revenue Code (IRC). These requirements include to primarily own income-generated real estate for the long term and distribute income to shareholders. Specifically, a company must meet the following requirements to qualify as a REIT. Invest at least 75% of total assets in real estate, cash or US Treasuries. Derive at least 75% of gross income from rents, interest, mortgages that finance real property or real estate sale. Pay a minimum of 90% of taxable income in the form of shareholders' dividends each year. Be an entity that's taxable as a corporation. Be managed by a board of directors or trustees. Have at least 100 shareholders after its first year of existence. Have no more than 50% of its shares held by 5 or fewer individuals. But now, without further ado, let's go in our top 5 REITs you should invest in 2021. The first one is STORE Capital Corporation, ticker STORE. STORE is an internally managed net lease REIT that is the leader in acquisition, investment and management of single-tenant operation real estate, which is target market and inspiration for its name. STORE Capital has a dividend yield of 4.64% with a decent growth over the last year. The latest price of the stock is $31. So what makes STORE Capital a very good REIT to invest in 2021? The payout ratio is 75%, which is low for REITs, and they have a dividend streak of 6 years without even a reduction. Here you can see their annualized dividend per share, and you can see that since 2014 they increased really a lot. The frequency of the dividend is quarterly, and the annualized payout was $1.44. Here you can see the history of the latest dividends, and you can see the increase in the last years. For the reasons I said, I think STORE Capital is a very good addition to your portfolio. A $31 investment, which is the share price today, will make you $1.44 a year just by holding the stock. The second REIT we are talking about today is Realty Income, the monthly dividend company. Yes, you heard that right. Realty Income pays dividends monthly. Realty Income was founded in 1969 to provide investors with monthly dividend and increase over time. Dividends are supported by a revenue generated from net leased real estate assets, publicly traded on New York Stock Exchange since 1994. So why should invest in Realty Income? Since 1994, which was the year of their listing in the New York Stock Exchange, they increased property in their portfolio from 630 to more than 6,000 in 49 states, Puerto Rico, and United Kingdom. The real estate assets at cost went from $500 million to more than $20 billion. In 27 years, the tenants went from 23 to more than 600. Also, their total number of industries in their portfolio went from 5 to 51. The annual revenue went from 50 million to 1.5 billion. And finally, their annualized cash dividend went from 90 cents to $2.8 per share. So what about today? Realty Income has a dividend yield of 4.76%, and it has shown a 3% growth last year. The share price $59. Some other things we should say about Realty Income that they have a payout ratio of 82%, which is not that good as store capital, but is acceptable. One other thing we should mention is that they have a dividend streak of more than 25 years without even a reduction. And during the 2008 recession, the dividend increased. Here you can see the annualized dividend per share from 2000 to 2020. As I said at the beginning, Realty Income is one of the few companies that has a monthly dividend. They basically pay you each month when you hold the share. For example, if you hold one share which is $59, you're gonna receive 23 cents each month just for holding it. For the reasons I just said, I think having Realty Income in your portfolio is a must if you're looking for a dividend growth strategy. The third REIT we're talking about today is STAG Industrial. STAG Industrial Inc. is a real estate investment trust focused on the acquisition and operation of single-tenant industrial properties throughout the United States. By targeting this type of property, STAG has developed an investment strategy that helps investors find a powerful balance in income plus growth. Their enterprise value is $6.3 billion. They have almost 100 million square feet of properties divided in 38 states in 462 buildings. STAG Industrial has a 4.87 dividend yield. Its share price is around $30. In the last year, they didn't have a very nice dividend growth. That was probably because of the pandemic, of the fact that many people had to work at home. They have a payout ratio of 75%, which is enough high for an industrial REIT. Anyway, they have a dividend streak of 8 years without a reduction. Here we can see the dividend growth starting 2010. STAG Industrial, exactly like Realty Income, they pay dividend monthly, and their annualized payout per share is $1.45. This means if you buy one stock that is priced around $30, you're gonna get $1.45 per year, which is around 12 cents per month, just by holding the share. Next up, Digital Realty Trust, ticker DLR. Digital Realty supports the world's leading enterprises and service providers by delivering the full spectrum of data center, colocation, and interconnection solution. Platform Digital R, the company's global data center platform, provides customers trusted foundation and proven pervasive data center architecture (PDXTM) solution methodology for scaling digital business and efficiency, managing data gravity challenges. Digital Realty's global data center footprint gives customers access to the connected communities that matter to them, with more than 284 facilities in 48 metros across 23 countries and 6 continents. DLR has a dividend yield of 3.11%, which is not that high compared to other REITs, but it's really safe. They also had a dividend growth last year of 4%. This REIT has a payout ratio of 76%, which is low for REITs. They have a dividend streak of 16 years without a reduction, and during the recession in 2008, the dividend also increased. If you look at the annual dividend per share, we can see the really exponential growth from 2004, that was around 20 cents, to now that is more than $4. DLR pays dividend quarterly, and annualized payout is $4.50 almost. This means if you buy a share that is priced at around $144, you will get $4.48 per year, or $1.12 every quarter. I think Digital Realty Trust is a very good addition to your portfolio if you want to differentiate from residential REITs. So finally, the latest REITs for today, it's WP Carey. It has a dividend yield of 6.3%, which is among the highest in the industry. WP Carey ranks among the largest net lease REITs with an enterprise value of approximately $18 billion and a diversified portfolio of operational critical commercial real estate that includes more than 1,000 net lease properties covering approximately 142 million square feet as of September 2020. For nearly 5 decades, the company has invested in high-quality single-tenant industrial, warehouse, office, retail, and self-storage properties subject to long-term net leases with built-in rent escalators. Its portfolio is located primarily in the United States and Northern and Western Europe, and is well diversified by tenant, property type, geographic location, and tenant industry. For the nature of their business, in 2020, the dividend hasn't grown that much, but it's already really high, like I said, 6.3%. Let's give you some metrics. The payout ratio is 86%, which is a bit high for REITs, but it's okay. But they have a dividend streak of more than 20 years without a reduction. Also, during the crisis in 2008, their dividend increased. Here we can see their dividends in the last 20 years, and you can see how solid they are. The company pays dividend quarterly, and their annualized payout is $4.18. This means if you buy a share that is priced around $66 now, you will get a little more than $1 every 3 months. So that's it for me today. Thank you very much for tuning in. Please like the video, subscribe to the channel, and comment down below if you want to see more content from me. Also, please tell me if you hold these REITs or if you have others to suggest. Thank you so much. Have a nice day.